Ran the numbers on 2025 yesterday. Not just trading P&L. The full picture. What came in, what went out, what actually compounded while I wasn't looking at screens. Made me think about something that's been bothering me for a while. There's a distinction in how people build wealth that nobody in this space talks about. And once you see it, it's hard to unsee it. Two types of people enter 2026. The first type has what I call fixed earning velocity. Their income grows maybe 3% annually if they're lucky. Ceiling determined by someone else, HR department, industry averages, whatever their boss decides they're worth this year. The only variable they control is time. For this person, the standard advice works perfectly. Save 10% of your income. Buy index funds. Dollar cost average for 40 years. Let compound interest do the heavy lifting. The math is real. $500 a month at 8% annual returns gets you to $1.4 million by 65. Solid retirement. Nothing wrong with it. But here's what nobody mentions. That math assumes your earning velocity is fixed. That you can't change how much fuel you're deploying. That patience is your only lever. The second type has skill-based earning velocity. Their income ceiling depends on execution, not approval. No HR meeting required. The bottleneck isn't time, it's how fast they can deploy capital into things that compound. Same index funds available to both types. Same real estate markets. Same dividend stocks. But different potential. Let me explain the optimization flip. If you're in the first category, patience is the correct strategy. You're playing the long game because it's the only game available. Nothing wrong with that. If you're in the second category, or building toward it, patience is actually the wrong optimization. Think about it. You're not trying to turn $500 a month into millions over 40 years. You're trying to generate and deploy $5 a 10 kilowatt month into income-producing assets while your skills still work, while your energy is high, while compound time actually matters. The wealthy don't start passive. They go active aggressively, then passive systematically. That's the distinction that changes everything. The part. Most investing content skips. Every finance influencer will tell you where to put your money. Index funds versus individual stocks. Real estate allocation percentages. Dividend reinvestment strategies. Tax-advantaged accounts. All useful. All correct. None of it matters if you're deploying $500 a month instead of $5,000. The vehicle isn't the variable. The fuel is. And almost nobody talks about how to actually generate fuel worth deploying. They just assume you have it, or that a little more from your salary will somehow you'll figure it out, or that saving close a gap that math says takes 40 years to close. The guy saving $800 a month and the guy deploying $8,000 a month have access to identical investment vehicles. They won't arrive at the same place. They won't arrive in the same decade. What actually changes the category? I've thought about this a good amount. Talked to enough traders who made the jump to see the pattern. The shift from fixed to skill-based velocity requires one thing, a skill that lets you increase your income independent of someone else's decision about your worth. Trading is what I chose. Not the only option, but the one I know works because I've lived both sides, the blown accounts and the consistent 5-figure months. The difference wasn't talent or luck. It was understanding market mechanics at a level that made execution systematic instead of hopeful. Systems is a clear distinction between those scaling and those not in 2026, and that goes far beyond trading. Just take a look at any other market in the online space. This year's question. Here's what I'd be asking myself right now. Am I optimizing for patience because it's the right strategy for my situation? Or because I haven't built the skill that let me optimize for deployment speed instead? Both paths reach wealth. Only one gets there before 50. I built something for 2026 that addresses this directly. Not investing advice, there's enough of that. The mechanism that actually shifts which category you're operating in.